The VIX is not a fear gauge. That phrase gets repeated on financial television approximately every time the S&P moves more than 1% in either direction, which is often. What the VIX actually is, a real-time calculation of 30-day implied volatility derived from the bid-ask midpoints of a wide strip of S&P 500 options, both calls and puts, across multiple expiration dates. The CBOE extracts a single annualized volatility number from that strip. When the VIX reads 17, it is telling you that options market participants are collectively pricing in annualized volatility of 17%. That translates to an expected daily move of roughly 1.07%. Not fear. A probability distribution, with a price attached to it. The CBOE methodology, introduced in 2003, does not rely on a single at-the-money option. It aggregates a strip of out-of-the-money puts and calls spanning strikes from roughly 50% to 150% of the current S&P level. Each option contributes to a weighted variance calculation. The formula solves for the expected variance of the index over the next 30 calendar days, then takes the square root and annualizes it. This structure means the VIX is more sensitive to demand for downside puts than upside calls. Because institutional hedgers systematically overpay for tail protection, a VIX of 20 does not mean the market expects a 20% drawdown. It means the option strip is priced as if annualized volatility will be 20. Those are meaningfully different statements. Historically, implied volatility as measured by the VIX has exceeded realized volatility roughly 80% of the time. The average spread has been approximately 3.5 to 4 volatility points. This is not a market inefficiency waiting to be arbitraged into oblivion. It is structural. Dealers who sell options carry negative gamma positions. They need a risk premium to compensate for the cost of dynamic hedging when markets move. Investors who buy puts are paying for insurance, and insurance premiums exceed actuarial fair value by design. The implication: when the VIX reads 18 and the trailing 30-day realized volatility is 12, you are looking at a 6-point premium. That premium is the market telling you hedging demand currently exceeds pure volatility expectation by a quantifiable margin. The VIX index measures 30-day implied volatility, but VIX futures trade across a curve extending to 8 monthly expirations. Under normal conditions, that curve slopes upward. The front-month VIX future trades near 16, the 6-month contract near 20. This is contango, and it reflects the fact that uncertainty compounds over time. When the curve inverts, front-month VIX futures exceed back-month contracts, that is, backwardation, and it has historically been a reliable indicator of acute, near-term stress rather than structural regime change. In late 2018, the VIX spot briefly touched 36, while the 6-month future held near 22. The curve was telling you the stress was acute, not persistent. Traders who read only the spot number missed that distinction entirely. Two misreadings account for most retail losses tied to volatility instruments. First, treating a rising VIX as a direct buy signal for equities. The VIX can rise from 18 to 28 and keep rising to 45. The spike itself carries no timing information. Second, treating a low VIX as complacency to fade. In 2017, the VIX averaged below 11 for an extended period, while the S&P returned over 19%. Low implied volatility reflected a genuine low volatility realized environment, not irrational calm. The more useful question is never what level the VIX is at, but whether implied volatility is elevated or compressed relative to its own realized volatility over the same window. The ratio, not the level, is where information lives. At a VIX in the mid to upper teens, the options market is pricing annualized volatility of roughly 17 to 19%. Trailing 20-day realized volatility in recent sessions has been running closer to 13 to 14%. That 4 to 5 point implied realized spread is within historical norms but above the post-2020 average of approximately 3 points. The skew surface is the more instructive read. Put skew on the S&P, meaning how much more expensive 25 delta puts are relative to 25 delta calls, has been elevated relative to its one-year average. That asymmetry suggests institutional hedgers are not complacent. They are paying above-average premiums for downside protection, while the headline VIX number looks moderate. The surface contradicts the index. Trust the surface. When put skew is elevated and the VIX headline reads moderate, you have a specific setup. Downside protection is expensive in absolute terms, but the market is not pricing a near-term crisis. That creates asymmetry in two directions. First, selling premium outright is unattractive. You are collecting inflated vol but carrying real tail exposure. Second, structured hedges using spreads. Specifically, buying a near-dated put spread where you sell a lower strike to offset elevated premium can provide cost-effective downside coverage without overpaying for the tail. The forward question is not whether the VIX will spike. It is whether current skew is pricing a risk that the macro data does not yet confirm. If that divergence closes with macro deteriorating rather than hedges unwinding, the option strip will have told you roughly 3 to 4 weeks in advance.